You've probably heard it said, this is not your father's Oldsmobile. In a way of saying things change, and generally things change for the better. And the bottom line is, when it comes to investing, you need to make sure that you're not investing, banking on things to be the way they were in your father's day and time, nor should you be investing like your daughter. Welcome to the Ease into Retirement podcast. I'm Tom Mosley, your host, and I promise you if you'll give me around 15 minutes, I'll do my best to increase your financial knowledge. I want to make sure you understand, as we say, this is not tax, legal, or investment, or even gardening advice for you specifically. You need to make sure and run the ideas that you hear about on this program through your financial advisor, through sound reasoning and thought, and make sure that it's the right thing for you. Nobody's smart enough to over the airwaves like this to give a blanket endorsement or a blanket recommendation that this is something you should or you shouldn't do. Now, this is episode number 25. I guess you would call that a milestone of some sorts. We've been doing it for half a year now almost. And we are in a 7-part series called Building Your Financial House. And this is the 4th episode of 7. And today we're going to address the subject of investments. Now, if you've been in our office here in Anaheim, you've seen the little thing we've got on the wall that's got the house. The foundation of the house is income. That's what we talked about in sessions 22 and 23. If you missed those two, go back and pick them up. And then last week we talked about inflation. That was session 24. Go back and talk about and look and see how inflation can impact your retirement financial house. Today we're going to talk about investments. And you shouldn't invest the way your father invested, nor should you invest like your daughter. That's point 1 and point 2. Let's talk about your father. And here's my point, number 1. In the good old days of investing, you could play it safe and not starve. Let me say it again. In the good old days of investing, you could play it safe and not starve. Now, there was a time, not too long ago, but there was a time when you could actually go to the bank and invest in CDs, or you could go to a broker and you could buy bonds, and you could use a strategy called maybe laddering or layering, or it was called different things. But what you would do is when you started, you would put 1/5 of your money in 5 different things. You would buy a 1-year, a 2-year, a 3-year, a 4-year, and a 5-year CD, or a 1, 2, 3, 4, or 5-year bond. You'd buy all 5 of those things. And you would start your program. At the end of year 1, your 1-year CD or bond would come due, so you would cash out the interest, which generally, here's the deal, was maybe 5, maybe 6, maybe 7, maybe 8. I'm not even talking about the Jimmy Carter good old days when you could actually get a CD that would pay north of 15%, and bonds were just doing a phenomenal payout at that time. But you cash out that 1 year and you reinvest the principal, but you live off of the gain. And then immediately that one day in and you bought that new 5-year CD, the 2-year had become the 1 year. The 3-year had become the 2-year. The 4-year had 3 years left, and the 5 years had 4 years left, and the new 5-year had 5 years. So you just kept that laddering going with bonds or with CDs over and over again. That was your father's Oldsmobile, because bonds, CDs, any kind of permanent investment, one reason is because we flooded the market with so much cash by buying bonds, and interest rates have been suppressed or kept extremely low right now by the Fed. And you can argue whether that's a good thing or a bad thing. But what's happening is people are not able to make a living unless you've got a tremendous amount of money in a CD or a tremendous amount of money in a bond laddering program. So those days don't exist anymore. For many of you, the pension that your father had doesn't exist anymore. Oh, you've got the 401k, but even at their core, the pension is called a defined benefit. In other words, a definite benefit program. And the 401k is called a defined contribution program. Now, when they first started, employers were very quick sometimes to match. And you would put in 3%, they would match it with 3. You'd put in 5, they'd match it with 5. But anymore, the matches, it seems, have gone down quite a bit. And employers are not matching. It's pretty much whatever you put in the 401k, it grows in a tax deferred. But the contribution of the defined contribution 401k, it's on your back as the person putting in the money. Maybe that's the way yours was when you were working. Pensions, you say, what are those? I didn't have one. My dad did. Your dad didn't have the 401k that was based on his own contribution, but he or your mom might have had a pension from the company or the entity that they worked for. So the retirement rules have changed in that you can't just back off and be safe, quote, so that you put them in bonds or you put them in CDs, because if you put your assets in those, you may starve because of the low payouts. So in the good old days, you could play that way. Number two, you can't go the other extreme as well. And I would title this point, after a 13-year bull market without a major downturn, you should not be investing like your daughter. Now, I say daughter because I've got 4 versus my one son, Travis, so the girls win on this one, okay? Point number 2. Point number 1 was you can't invest like your father did because those things don't exist anymore. Number 2, you shouldn't invest like your daughter should and could and probably we hope is, because you are in a different ballpark. Now, here's what I mean. When my children, who are 24, 28, 31, 42, and 43 right now, when they come to me and they ask me for advice, the most recent one was a 19-year-old grandson, Owen. And Owen called me and asked me for investment advice. Now, I don't ever force them, and pretty much they're on their own to do with it whatever they want to do, but I always give them this advice when it comes to saving for retirement. If they're saving for a house, it's different. If they're saving for a car, it's different. If they're trying to pay off credit cards, for goodness sakes, pay them off now. Okay, don't wait. But if they're saving for retirement, which is a long way away, my oldest daughter, Amanda, is still 16 years away from retirement age of 59 and a half. And my youngest daughter, Mackenzie, is 35 and a half years away from retirement age of 59 and a half. I tell them, put your money in the market in something pretty risky, but pretty solid, and don't look at it until you're 55. Now, why do I tell them that? Because the market's rocky. It's up, it's down, it's sideways. It's all over the place. Now, since 2009, we really haven't had a major downturn. Last year, we had a 37% downturn in the stock markets in March, or right in that area. But then we had a V bounce. It bounced back up. And it went down in 22 or so days, about 22 days, and it bounced back up almost immediately. Almost 3 or 4 months later, it was back to where it was. That's not what we're talking about. What we're talking about, a major downturn, is like a 2008 downturn that it takes years for it to recover. Or a 2000, 2001, 2002, 3-year downturn where it took years for it to recover. You can't afford to invest like my 24-year-old daughter, Mackenzie. Mackenzie can put that money away, and yes, it's going to go through ups and downs. But if you look at a chart of the stock market, and in many of the classes we've taught in the past, we've shown you what's called a Guggenheim chart because it's put out by the Guggenheim Company, which is, they own several financial institutions. And if you look at the stock market, generally from 1896 until now, it's gone up and up and up and up and up. But if you take a microscope and you look at it a little closer, you've got several periods, like from 1929 to 1940, where it was flat. Actually, 1945, for 16 years, it just took it 16 years to get back to where it was. Actually, from 2000 to 2009, the market lost 1% a year, the S&P 500, during that 10-year decade.
Hey folks, thank you for listening to today's episode of the Ease into Retirement podcast with Tom Mosley. Just a quick reminder that if anything you've heard so far today has hit home for you, maybe it's something you're dealing with, maybe it's just something you want to learn a little bit more about, there will be a complimentary downloadable giveaway on Tom's website specifically prepared for this week's episode that you should check out. Just go to easepodcast.com. That's EASE podcast.com. Click the button with the title of this week's episode and get your copy today. Now I'll throw it back to Tom.
Now, in retirement, you can't afford to just wait it out because you don't have that magic four-letter word spelled T-I-M-E. Now, as my daughters and as my son gets closer to retirement, if I'm still around, I'm going to tell them, you need to start backing down your risk. You need to start backing down your risk because you're moving. Right now, if you're still accumulating like they are, they're in the accumulation phase. But as soon as you retire, you're not accumulating anymore. You might be growing, but you're not adding to it anymore. In fact, most of you begin to take it out. So it's like climbing up the mountain for accumulation. And one of the reasons for 26 years now plus, we've majored in helping retirees do our best to make sure they don't run out of money in retirement. One of the reasons we've done that is because that coming down the mountain is a lot more treacherous than going up the mountain. Going up the mountain, you know about when you're going to retire. You know to save it. You know to put it away, and you know how much you have. Coming down the mountain, you don't know how long you have. You don't know what the stock market's going to do that might cut your assets in half during a downturn. You say, in half? Yeah, it pretty much did that in 2008. And it more than did that in 2000, 2001, 2002. The market does have its huge corrections. So you can't invest like your daughter can invest. I'm an old football coach and I hate to keep falling back on football illustrations. No, I don't really, but I just have to say that. But anyway, in football, if you're ahead by 3 touchdowns with 5 minutes to go, you should never lose that game because all you have to do is run out the clock. You've got enough points to win. Most of the people who come to us have enough money that the biggest thing they need to do is secure their income and make sure that the rest of it, their paycheck, is there so that they can use it. So point number 1 was, it's not like your father's Oldsmobile. Those good old days of investing aren't here with CDs and bonds right now. Number 2, you shouldn't be investing like your daughter because your daughter has the time on her side. Your son has the time on his side to outlive it. Number 3, here's the deal. You should be investing at a risk level, you ready, that allows you to sleep at night. Now you say, what is that? I don't know, but I can tell you if you'll give me a chance. Most of you who are our clients have taken a little evaluation called Riskalyze. And that Riskalyze allows you to go through certain choices, about 17 maximum questions, where you've got a choice of A, something that's certain, or B, something that's a 50-50 chance of gain or loss. And when you take that evaluation, now get a load of this. I've been giving that Riskalyze for 4 years. I've had one person tell me they didn't think that was really where they were when it came out with a risk score of from 0 to 100. A year later, after we invested outside of that person's range by their request, they came back to us and said, no. Move me back to that number. It was right. So that's how accurate this little evaluation is. And you've got to be careful. Last week, at the time I'm making this podcast, last week, we had a client, I never mention any names, not a client, but a prospect came in, and they told us they had asked their broker to put them into something that was mildly conservative. That was the exact words they used. It was the exact words they told their broker. When we did the analysis on their portfolio, they were taking exactly 100% of the risk of the stock market. And they had told the person who was helping them that they wanted to be mildly conservative. Now wait, for the last 13 years, we've had an up bull market. So they're happy. because they've been, quote, mildly conservative, but in reality taking 100% of the risk of the market, and they've been going up, 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 and up. Actually, when we looked at their portfolio, they'd only gained about 75% as much as the market had gained. But bad news is they were taking 75% of the risk of the market. The really bad news, they had only gotten 75% of the gain of the market, and the really bad news was they were taking 100% of the risk of the market. What's going to happen to that couple if they stay where they are, although they're happy with the way the market's gone overall for the past 13 years? What's going to happen to that couple the next 50% downturn we have? Not a matter of if, but a matter of when. If they are depending on that money for retirement, and they go from $1,030,000 and something, and they go down to $500,000, that's going to put their retirement in much more jeopardy. So what was the podcast today? Number one, the things that were available to your parents aren't still here. Number two, you can't afford, in most cases, to be taking as much risk as your children can afford to take with your retirement money. And number three, you need to know your risk score so that you can invest at a risk level that allows you to sleep at night. Now, like I've always said, this podcast is not meant for you to go out and make a decision without getting advice. Call us, 714-421-4288. Email me, tom@easeintoretirement.com. If you want to take the Riskalyzer, or you haven't taken it in a while, or you've never taken it, let us know, and I'll have Charlie send that out to you so that you can take the Riskalyze, and you can know what your risk score is and know what level that evaluation tells us that will allow you to sleep at night. But remember, as you're evaluating all of this, don't run out and do something, because this is not tax, legal, investment, or gardening advice. It's general information to help you think about where your portfolio is. I would rather you evaluate it and be content with where you are, if it's the right place, than especially you not evaluate it and something bad happen to your investment savings. Remember, we're trying to build you a financial house. We've talked about income in episodes 22 and 23. We've talked about inflation last week in episode 24. And today we've talked about investments. Next week, we're going to talk about taxes. Until next time, this is the Ease into Retirement podcast. Tom Mosley here. If you'll give me 15, 16, 17 minutes like today, I'll do my best to build your financial knowledge.
Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Mosley Insurance and Financial Services are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Mosley Insurance and Financial Services is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Mosley Insurance and Financial Services. Ed Slott's IRA Advisor Group is a paid membership educational organization comprised of professionals of varying credentials. Membership in this organization does not imply a set level of skill or training. The logo and or service mark is the property of their respective owners, and no endorsement of Tom Mosley is stated or implied.
A Roth conversion is a taxable event and may have several tax-related consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.